Right now, SoFi Technologies, ticker SOFI, is trading at $30.03, which is a significant jump of $1.82 or 6.45% in live intraday trading on Monday, November 10, 2025. This isn't just a minor drift, this is a high-volume, high-conviction move, and it's happening as the market continues to digest what SoFi has become. While many investors are looking at this price action and seeing the continuation of a powerful post-earnings rally, they are missing the real story unfolding just beneath the surface. The expectation of SoFi as a simple, high-growth fintech name is being completely shattered by the reality of its business model, and the data proves it. The disconnect between what people think SoFi is and what it actually is precisely where the opportunity and the risk now lie. This stock is no longer just a bet on student loan refinancing. It's a bet on a full-scale financial technology ecosystem, and the market is only now catching on. The common belief, the narrative that has defined SoFi for years, is that it's a high-beta speculative stock tied to the whims of interest rates and government policy on student loans. It's often lumped in with other online investing platforms that saw a boom and bust cycle. For many, it's a name they see on their Robinhood app fluctuating wildly alongside Tesla stock or other high-momentum names, a place for Robinhood stock trading, but not necessarily for a long-term core holding. The expectation is that when rates are low, SoFi does well, and when rates are high, its lending business gets squeezed. This perception has been sticky, and frankly, for a long time, it was mostly true. Investors expected a volatile ride, and that's what they got. But the reality, with the most recent quarterly numbers just proved beyond a shadow of a doubt, is that this old narrative is obsolete. SoFi has successfully executed a difficult transition. The company that was once a single-product lender is now a diversified financial services and technology platform, and the lending part is no longer even the main driver of its growth. Let's look at the hard numbers from that recent third-quarter report, because this is what's fueling today's 6.45% surge. SoFi reported record-adjusted net revenue of over $950 million, a 38% increase year-over-year. But here is the critical data point. For the first time, the financial services and technology platform segments, that's the SoFi Invest side, the banking, the tech that powers other fintechs, generated $534 million in revenue, a staggering 57% increase. This segment now accounts for 56% of the company's total revenue. This is the pivot. It's no longer a lending company with a tech side business. It's a tech company that also has a highly efficient lending arm. They added a record 905,000 new members, bringing their total to 12.6 million. They also added 1.4 million new products. This isn't just growth, it's the flywheel in full effect. The cross-buy rate, which is the percentage of new products taken by existing members, hit 40%, its highest level since 2022. This means the one-stop shop strategy isn't just a marketing slogan, it's working. They are successfully pulling people in with one product, like SoFi Invest or a high-yield savings account, and then selling them SoFi stocks, SoFi ETFs, and eventually a loan, or SoFi Active Investing Services. This is the holy grail for a consumer finance company, a sticky ecosystem that rivals what the giants like Fidelity have been building for decades. This is why today's move is so important. The market is seeing a stock that just delivered its 8th consecutive GAAP profitability, with $139 million in net income. Management didn't just meet guidance, they raised it for the full year. This confidence is contagious. We're seeing analysts split, which creates the tension for a big move. You have firms like Jefferies raising their price target to $35, seeing this new reality, while others like Keith Brewett are sticking to a sell rating with a $20 target, presumably anchored to the old valuation models that focused purely on the lending book. This division is what creates volume. The stock has been volatile, certainly. It saw a sharp 10% pullback on heavy volume just last Thursday, as some traders took profits after an incredible 180% run-up over the past year. But today's rebound demonstrates that buyers are stepping in on any weakness, treating that dip as a loading opportunity, not a warning sign. This is the classic signature of a stock undergoing a fundamental re-rating. What's fascinating is the institutional activity. While the headline numbers from recent 13F filings might look confusing, with some data suggesting a rotation out, the reality is a war between narratives. You have some large funds that held SoFi from its SPAC days who are absolutely cashing out after this massive run-up. They see a high valuation and are taking their win. But at the same time, new and arguably more strategic institutional players are building major positions, like Sumitomo Mitsuy's recent accumulation. These new buyers aren't betting on the old lending story, they are betting on the new technology platform story. They are looking at SoFi's Galileo, the picks and shovels tech platform that powers other fintechs, and comparing it to the high-margin, capital-light backbones of other sectors. It's not unlike how the market had to reevaluate NVIDIA stock, moving it from a gaming card company to the AI infrastructure company. SoFi is trying to make that same leap in the perception of the financial world. So what does SoFi actually do? It's a three-legged stool. First, you have the lending segment: personal loans, student loan refinancing, and home loans. This is the legacy business. It's profitable, efficient, and now funded by SoFi's own massive base of low-cost deposits from its banking charter, which is a huge competitive advantage. Second, the technology platform, primarily Galileo. This is the B2B, business-to-business side. Galileo provides the APIs and back-end infrastructure for other companies, even competitors, to build their own banking and card services. This is a high-margin, recurring revenue business. Third, the financial services segment. This is the super app, the consumer-facing ecosystem. This includes SoFi Invest, their individual brokerage for self-investing, SoFi Stocks and SoFi ETFs, a SoFi robo-advisor to compete with Schwab Intelligent Portfolios, plus checking and savings, credit cards, and insurance. This is the flywheel. They use the financial services products, which are often low cost, to acquire members. They deepen the relationship with these members, who then become prime customers for the high-profit lending segment. And the whole thing is built on their own tech platform, which lowers costs and creates a seamless investing sites experience. This ecosystem approach is a direct assault on the entire financial industry. When a user opens a SoFi Invest account, they are being pulled away from Fidelity or Interactive Brokers. While Interactive Brokers clearly dominates the professional Interactive Brokers trading space with its advanced Interactive Brokers platform and low Interactive Brokers fees, SoFi isn't trying to win that client. It's targeting the mass affluent professional who wants their entire financial life in one clean Fidelity mobile app-style experience, but with better rates and integration. SoFi is challenging the Fidelity brokerage model by offering free investment help and a SoFi trading platform that's simple but also connects to their bank account and credit score. It's a different value proposition than a legacy firm like Fidelity, which might offer a wider array of Fidelity mutual funds or complex Fidelity wealth management services. SoFi is betting on convenience and integration over sheer breadth. It's also a different approach than Robinhood. While Robinhood built its brand on Robinhood fractional shares and Robinhood crypto, it struggled to be seen as a serious financial partner. SoFi is trying to capture that same digitally native user but grow with them, offering them a mortgage when they buy a house and a Fidelity IRA-style retirement account when they get serious about saving. This brings us to the future outlook, the expectation versus reality for 2026 and beyond. The primary catalyst is continued execution of this flywheel. Can they keep member growth above 30%? Can they keep pushing that cross-buy rate higher? If they can, the high-margin fee-based revenue from the tech and financial services segments will continue to outpace lending growth, forcing the market to assign it a much higher tech-like valuation multiple. The second catalyst is the tech platform itself. As more financial services become embedded, Galileo is perfectly positioned to be the infrastructure provider for a host of non-financial companies that want to offer banking services. This is the part of the business that the market still struggles to value properly. The risks, however, are very real. First, valuation. The stock is up dramatically. Its price-to-earnings ratio is high, and a lot of good news is already reflected in today's $30 price. Any slip-up in member growth or a compression in margins could be severely punished. Second, the macroeconomic picture. While SoFi is less of a pure lender now, a deep and prolonged recession would still hurt. Loan demand would fall and delinquencies would rise, even in their high-quality book of prime borrowers. This would hit sentiment hard, regardless of how well the tech platform is doing. Finally, the competition is not sleeping. Fidelity Investments is pouring billions into its own digital platforms. Interactive Brokers is a global force in Interactive Brokers stock trading, and Robinhood, with its massive user base, is trying to build out its own ecosystem with products like Robinhood Cash Management. SoFi is fighting a multi-front war against